Alright class, welcome back. Today we're going to continue Chapter 3. We're actually going to conclude Chapter 3 with Chapter 3 Part 3. And today's pretty simple, nothing crazy that we're going to be going through, but what we're going to be doing is we're going to be adding another 3 accounts. Remember, yesterday we talked about different accounts being a way to categorize or keep better track of what's going on in your assets, your liabilities, and your owner's equity. So we gave some description to the different assets. We either called them cash or equipment or land or supplies. We pretty much put names to them. The accounts that we talked about as far as our liabilities was accounts payable, right? That's when we owe people money. We discussed the asset account, accounts receivable. And today we're going to look at capital, and we're going to look at 3 accounts that affect our capital. All right? Those 3 accounts that we're going to be talking about: revenue, expenses, and withdrawals. 2 of those accounts will actually decrease the owner's capital, and 1 of those accounts will add to or will increase the owner's capital. So let's get into it. First one we're going to look at today is a revenue account. Revenue is income earned from the sale of goods or providing services. So if somebody comes into your store and they buy one of your products and you sell it to them, they would either give you cash or they would promise to pay you later, and at that point it's considered to be a sale. You've made a sale with a customer and you've earned revenue. So that's income that's earned, all right? Fees earned for a service performed. So fees a lot of times we think of as being something that we have to pay. There are fees that we get on our cell phone bills, or there are fees that the credit card company gives us. That's actually income or revenue for the credit card company over your cell phone provider. Those are fees that they charge, and they receive income because of it. So I want you to stop thinking about fees as something that you have to pay. Remember, you're not a customer. You work for a business as a bookkeeper. A fee is something that your business would receive from a customer. Also, cash received from a sale of merchandise. So that's when simply somebody comes into your store and they were to pay you cash for the merchandise that you sold to them. So that's revenue. Revenue is something that would come into your business. It's when you make a sale to your customer or you provide a service to your customer. The next one we're going to talk about is expenses. Expenses is the cost of producing or providing services to your customers. So expenses, example, would be the rent, right? Rent is something that you have to pay in order to stay in your building or your facility. Utilities. Utilities describes your water, electric, gas, all the things that you have to pay in order to keep your business operational. Those are what utilities expenses are. Those are the 3 main ones: water, electricity, and gas. And that's a bill that you have to pay every month. Advertising, you have to spend some money for advertising. The difference between expenses and assets, remember, assets are things of value, something that you could resell and get money for. After you pay the month's rent, you can't resell it. You just spent money to pay for that expense, but if you were to close down shop or anything, you can't go back and sell back last month's rent. It's something that you spent the money on, and it's pretty much gone forever. It doesn't hold any value. Expenses are just bills that you have to pay to keep your business going. The last one we're going to talk about today is withdrawals. Now, withdrawal is really the opposite of an investment. An investment is when the owner brings something of value, an asset, into the business, whether it's cash that they write out a check for, or maybe they take office equipment or supplies, maybe they take a computer from home and they give it to the business to use. A withdrawal is the exact opposite. A withdrawal is when the owner takes back something of value. So maybe they go to the business bank account and they take cash from it and give it back to themselves personally. That's a withdrawal. They're withdrawing an asset from the business. Or maybe they went and they gave the business a computer to use, and now they want to take that computer home for their own personal use. They're withdrawing that asset. Okay? These 3 are all considered to have effects on capital, because remember, capital shows us how much of the assets would be available to us if we were to liquidate or to sell our company. So in the case of the first one, revenue, if we were to go and sell items or provide services, one of our assets would increase. Either cash would increase or accounts receivable. Those are the 2 ways that we can account for providing a service for somebody. Either they give us cash then, or it's accounts receivable and we're waiting. Either way, our assets increase, so the owner's capital at the same time has to increase in order to show the relationship. If the business were to liquidate, who would have a claim to that new asset that revenue generated? Okay, so capital increases as accounts receivable increases and cash increases in a revenue transaction. The next one we talked about was expenses. Now remember, what do you typically pay your expenses with? In this accounting class, we're going to use cash, okay? So if you have to pay for the monthly rent, you gave your landlord cash. Or if you have to go and pay a utility bill, electric or gas, you have to pay the gas company cash. So when you go and pay them cash, the cash asset is going down, and if capital or owner's equity shows what our claim is to all the assets, guess what? Capital also has to decrease because now one of our assets went down. Our cash asset went down when we paid one of these bills. So an expense would decrease your capital or decrease your owner's equity. And then finally, the last one that we talked about today was withdrawals. And that's when the owner takes out an asset. Either a piece of machinery, equipment, supplies, they take an asset out, or when they take another asset, cash, right? Or if they were to take cash out. So anytime the owner takes an asset out, think about it this way. If capital shows the owner's claim or how much of the value of assets owners would get if the business were to shut down, now because you took one of the assets out of the business and brought it back home, if you were to liquidate, you would no longer have that value inside of your assets. So that would make your capital also go down because you lost value by taking that asset out of the business. Okay? We're going to go through some of the transactions to get you guys used to how to actually do the recording of these, but these are the 3 new accounts that we affected. Look out for a practice problem that I'll be adding shortly. So thank you. This concludes Chapter 3. You have sections 1, 2, and 3 all on the page. Check them out if you have any questions. You can come and ask me, or you guys can message me, or and I'll help you figure it out. All right, that concludes Chapter 3. Thank you.